Welcome to Financial Revelations. I am David Safransky. We're coming to you for the second time in 2022. I would have done more, but over Christmas I had COVID, and for about a month, I really couldn't say 4 consecutive words without coughing. And I feel a lot better now. I don't think I have a cough anymore. I'm guaranteed the cough now. My COVID experience was really kind of boring. Not really much happened. I felt like I had a cold for a couple of days. And if you get it, and I think we're all going to get it, hopefully your experience is very similar to mine in that you just didn't get that sick. You could follow us on Twitter at FI Revelations. FI Revelations. You could follow us on Twitter. And you could also email us questions or comments to Joshua at EPSF.com. And both of those addresses are going to be up here above my, we should sell ad space on my forehead because there's a lot of room up there. And so today I want to talk about, it's a little wonky, I'm going to be honest with you, but I think it'll be a good dinner conversation for you as if you have a work party to go to or you have friends over, and it is going to affect us long term. So I'd like to say we're going to be swimming in the deep end of the economic theory pool soon because the Fed is on the precipice of acting. And today, this is a perfect example. It's a Friday. It's February 4th as we record. And this morning, we got some news. And it's a perfect example of when good news is bad news. And what was the good news that turned out to be bad news? The good news was the jobs report was a blowout number. I mean, way more jobs than what we thought it was going to report. And not only that, but they went back and they revised November and December jobs reports up a lot, big numbers up. I don't know why. It's a little bit of a mystery why the numbers were so off. The one theory is that a lot of small businesses just ignore the Fed and the surveys. The Fed will send out surveys and say, how many people do you have working for you? How many people have you laid off? What's your average wage? You don't have to answer them, but a lot of people do answer them. And the Fed is saying that they're just getting slow or no responses. So the data is coming in a little choppy. Some of it's late. And so when they get it, they publish it and they revise numbers. So the numbers got revised. And why is this bad news? Why is this good news bad news? It should be good news, right? People are working. We like that. They're going back to work. We're seeing people there. This great resignation that happened where we lost about 5 million people in the job force. We have no idea where they went. And it's way too many people for aliens to have abducted. Aliens only abduct about 10,000 people a year. So 5 million is way too many. But where did they all go? We hadn't known, and now they're starting to come back. And the unemployment number that I follow is called the U6. The U6 table is everybody who's unemployed. That's the headline number. What news organizations report at 3.9% or 4% today. It went up a little bit. So the U6 has everybody that's unemployed, everybody who's underemployed. So if you have an engineer who's working at McDonald's, technically they're employed, but they're underemployed. So that's going to count in the U6 table. And everybody who's quit looking. So the unemployed, the underemployed, and the people who have just thrown their hands up and given up. Well, that number is also coming down, and that's a really good sign for the economy. So the reason why it's bad news, though, is because the Fed is really on the precipice of raising rates, and we get a blowout jobs number, which kind of gives them a lot of leeway to raise rates even more than what we had originally thought. So this morning, after the jobs number came out, bond rates jumped, and one of the reasons that happened is because wages went up pretty substantially, not as much as inflation. So inflation is still outpacing wage growth. So in real terms, you're losing money every year. And that's not a good thing, but wages did go up. And now the Fed really has a pretty big decision to make, whereas before it was, it was a quarter point 4 times, quarter point 3 times. I think now their decisions are really how many rate hikes and by how much. By how much was not even in the equation before. And now I think it could be, at least for the first rate hike. I think that they would have a green light to go with 50 basis points. So that would be to raise rates 0.5%. What does that do, really? It's kind of a blunt instrument for the Fed to raise rates. They have some other tools that are way more effective, but this kind of gets everybody's attention more than the other things, so that's why they like to use it. It raises the rates that they charge, the Federal Reserve charges banks for overnight loans. And when that happens, that means car loans go up in cost, the interest rates go up, your home loans go up. A year ago, you could get a 30-year fixed rate below 3%. Today, you can get a 30-year rate just below 4%. So rates have gone up a full percentage point almost. Credit card rates will go up. Now, I want to tell you something, though. If I have never, ever personally been worried about interest rates on my credit cards, and there's a good reason. My wife doesn't let me run a balance on my credit cards. I've never run a balance on a credit card. And I don't pay interest on my credit cards. And the very simple rule for credit cards is this. If you cannot pay your balance off every single month on your credit card, alarm bells should be ringing right here in between your ears because something is wrong. You're spending money you don't have, and you can't afford the things that you're buying. You have to be able to pay that credit card off every month. And if you do that, if you pay your credit card balance off every month, no matter what the bill says, you're never going to run into credit card problems. Consequently, I've never run into credit card problems. I don't take credit for that. My wife made me do it when we first got married. I was going to run a balance, and she saw my credit card statement. And I felt like a little kid. I still remember where I was standing when it happened. She said, "Oh no, we don't run balances on credit cards." And I thought, well, I'm going to get in trouble here. So I thought I should just behave. So we've never run a balance on credit cards. So how many rate hikes and by how much? 25 basis points was before. I think 50 basis points is in the cards now. And what the Fed is trying to do is tamp down inflation. We have inflation running at about 7%. And some of those things, some of the inflation numbers are going to come down. There's no doubt about that. Some are not. For instance, as we get some of the supply chain kinks worked out, which will happen eventually. I don't think it's going to be this year. I think if it is this year, it'll be December. But I think it's going to be more likely first or second quarter of next year that all the supply chain kinks get worked out. But fuel prices, that is a whole different story because fuel prices coming down is not going to happen because it's a man-made crisis. It's a man-made problem that we have done. This administration really, they have a war on fossil fuels by Joe Biden and the squad. They don't like fossil fuels. They want to electrify your car. I just read that California is trying to make natural gas stoves illegal. Well, that's a problem. I mean, a lot of people use natural gas to cook food. I'm not really a great cook, but I did listen to a chef on the radio who said cooking with an electric stove is going to kill restaurants. Apparently, they cook a lot differently. So there is a war on fossil fuels. There's about half the drilling rigs now for oil and gas than there were just a year and a half ago. Half. Our oil production here domestically is down 2 million barrels a day. We're begging the Saudis to produce more oil. We're actually more dependent today on Saudi Arabia and our enemies for oil than we have been in a couple of decades. It's really problematic. So that's one thing that's happening. Fuel prices oil topped to $92 a barrel today. It would not surprise me one bit to have oil above $100 sometime before June, maybe even this month. If Russia and Ukraine if Russia invades Ukraine, oil's going to $140 a barrel, probably overnight. That puts gas in middle America somewhere around $4, $4.25 a gallon. That's going to be problematic for the administration. So the Russia-Ukraine thing is really a big deal because Germany and a lot of Europe gets their natural gas from Russia. And if we're chastising them for the things that they're doing in Ukraine, they're going to cut off gas to Europe. Already in England, natural gas prices in some areas are 100% higher than what they were last winter. 100%. And in most places, they're at least 50 to 55% higher. They have the same war on fossil fuels in England that we're having here. They had one storage facility to store natural gas, and they closed it. So they're buying on what we call the spot market on a daily basis. It's a very expensive thing to do. So people in England have their heating bills doubling overnight practically. There's a lot of moving parts in this. I still am a strong believer in that the economy reopening is going to be enough to offset a lot of what the Fed is doing to keep us in profit mode. Companies will be making money. Portfolios will be making money. There's going to be some definitive soft spots like cryptocurrencies, and the highly levered companies are really going to be in trouble. We don't generally invest in those for our clients, so I think we're pretty good there. But what I want to encourage you guys to do, there's going to be some soft markets here in the next couple of months, because as the news breaks of what the Fed is doing and the responses to it, and if Russia does invade Ukraine, it has an effect on markets. And the way that I'm looking at them right now is mainly buying opportunities, perhaps not immediately. So if Russia crossed the line right now, I might not invest right now. I might let some dust settle, see what's going on, see what is actually happening on the ground. But I do look at these things as long-term buying opportunities, because eventually there's going to be somebody else in the White House, probably from the other side, because power is cyclical. That always happens. And when that does happen, I think you're going to see America's oil and gas industry reemerge from the ashes like a great phoenix, and we will be powerful again in the world energy market. And that's really important, because the people that we buy energy from that aren't us, they don't really like us. So in essence, we're financing hatred against us with our own money to power our cars. You know, one other thing about electrification of automobiles is that we get all of these rare earth materials. If we're going to continue to use a lithium battery, it is very problematic because it puts China right in our hip pocket. That's where we get all the materials to build and manufacture these batteries. Every time we don't drill for oil, we make them more powerful, China. Every time we don't drill for oil, we make the Middle East more powerful. It is really problematic. It is emboldening our enemies to do what they're doing right now. And that's why we do need a change. And that's going to happen in the midterms. There's going to be changes in the midterms for sure. And hopefully it will bring some rational thought to some of the things that are going on against our oil and gas industry, because we need them. You know, they talk about jobs, jobs, jobs. Well, the oil and gas industry provides a lot of jobs, high-paying jobs, good jobs, and it's problematic what they're doing right now, the administration that is. So I want to think about long-term investments, the greatest companies that America has and the world has to offer that have profits. We don't really generally invest in companies that don't have profits. A lot of people do, and I think that's going to come back and haunt them right now. So we're looking for the best companies with good cash flow and profits, and that's how we're going to invest, and we think long-term, and that's how I want you to think too. Remember, at FI Revelations on Twitter, and you can email Josh. It's joshua@epsf.com. I am David Safransky. This is Financial Revelations, and I'll see you soon.